A quiet revolution is reshaping India's non-banking financial sector. While retail investors focused on legacy giants, institutional capital silently observed a massive structural pivot. A premium mid-cap player transformed its entire balance sheet, completely rewriting its growth trajectory. By shedding high-risk legacy assets, this financial entity positioned itself to capture premium, technology-driven market share. The street may be fundamentally underestimating this structural realignment. This is not just a turnaround story, it is a blueprint for modern financial engineering in a highly competitive credit landscape. To understand the core moat of Poonawalla Fincorp, we have to look back at its massive corporate transformation. Formerly operating as Magma Fincorp, the company underwent an aggressive structural rehabilitation. Under new promoter ownership, the entity completely overhauled its legacy underwriting standards. They exited low-yield, operationally intensive segments like pre-owned commercial vehicles and rural housing. Instead, they redirected capital toward high-yield, premium consumer lending, professional loans, and secured MSME credit. This strategic pivot dramatically altered their risk-return profile. The new value proposition relies heavily on a digital-first, asset-light credit ecosystem. By focusing on cross-selling to high credit score customers, they insulated their balance sheet from high default risks. This structural shift allowed them to maintain a highly pristine asset class. This customer selection strategy is critical. It creates a robust barrier against the cyclical asset quality shocks that typically plague traditional shadow banks. This targeted approach has fundamentally redefined their operational moat in the consumer credit landscape. Looking closely at the financial trends, the resilience of their net interest margins becomes highly evident. In a volatile interest rate environment, maintaining stable margins is incredibly difficult. However, their strategic shift toward high-yielding, premium unsecured and semi-secured loans helped offset rising cost of funds. By scaling up their core asset book, they achieved significant operational efficiencies. This consistent balance sheet expansion indicates strong organic demand and pricing power, showcasing their superior relative strength. But the margin metrics tell only part of the story. The real differentiator lies in credit cost compression. By utilizing advanced algorithms and digital-only verification, they optimized risk management. This drove their net non-performing assets down to historic lows. For an NBFC, keeping net NP as near zero while aggressively growing AUM is a rare operational feat. This pristine credit quality acts as an institutional shock absorber, shielding the company from potential macro downturns. The next signal comes from management's corporate execution strategy. The leadership team has consistently focused on high ROE products. They deliberately avoided low-margin price wars in commodity lending sectors. Instead, they built strategic partnerships and focused on technology integration. This capital allocation model emphasizes profitability over simple size expansion. This disciplined approach suggests that management is building a sustainable, compound growth model rather than chasing short-term market hype. Here is where the business scalability becomes highly compelling. By employing a digital-first acquisition model, they kept customer acquisition costs low. This setup allows them to scale their credit book rapidly without heavy branch infrastructure investments. Co-lending arrangements with premier banking partners have further enhanced their capital efficiency. This structured co-lending strategy provides continuous liquidity, reducing balance sheet dependency and allowing the company to sustain high relative strength. Now look at how the broader sector is reacting. India's credit landscape is undergoing a massive structural transformation. The demand for consumption and MSME loans remains robust across Tier 2 and Tier 3 urban hubs. Traditional public sector banks often struggle to service these fast-paced credit demands due to legacy infrastructure. This massive demand gap provides a highly supportive macro tailwind, allowing nimble, tech-driven NBFCs to capture significant market share. The shadow banking space remains highly competitive. Industry titans like Bajaj Finance and Chola Investment command immense scale and historical data. However, the market is large enough to support specialized premium players. By carving out a niche in high credit score consumer segments, this operator avoids direct price wars. They compete on turnaround time and digital convenience rather than just low interest rates. This strategic positioning allows them to protect their margin profile. That leads us to a bigger question regarding terminal risk. While the growth trajectory remains impressive, systemic headwinds cannot be ignored. A persistent high interest rate environment poses a threat to all NBFCs. As systemic liquidity tightens, the cost of incremental borrowing rises. If the company cannot pass these rising costs on to its borrowers, we could see near-term net interest margin compression. This makes liability franchise diversification a key metric to monitor. Furthermore, regulatory compliance is a major operational variable. The central bank has recently increased risk weights on unsecured consumer loans to curb retail overleveraging. This regulatory tightening directly affects capital adequacy ratios across the entire shadow banking space. While the company's strong capital adequacy acts as a buffer, prolonged regulatory tightening could constrain leverage capacity. This regulatory shift might slow down the pace of overall credit expansion in the coming quarters. Despite these industry challenges, the forward earnings visibility for Poonawalla Fincorp remains robust. Their shift toward high-yield digital assets suggests strong relative strength. As the older legacy book fully runs off, the cleaner, high-yield digital book will drive overall profitability. If management sustains its targeted credit costs, the company could achieve a major valuation reassessment. This structural momentum makes it one of the most compelling execution stories in mid-cap finance. The long-term investment thesis here is built on institutional execution. This is no longer a speculative turnaround story. The business has successfully transitioned into a high-grade compounder. For long-term portfolio managers, the core focus remains on their ability to maintain low NP as during credit cycles. If they navigate the current rate cycle without credit deterioration, the structural premium will likely widen relative to peers. From a portfolio management perspective, we are placing Poonawalla Fincorp on our breakout watch. The stock has been building a strong consolidation base, showing key relative strength against broader mid-cap volatility. This technical structure suggests that institutional capital is quietly accumulating. However, we must monitor potential margin pressures and credit growth metrics closely. This balance between high-growth execution and systemic risk management will define its next major move. This structural transformation demonstrates how strategic capital allocation can revitalize a legacy business. To receive premium, institutional-grade equity research like this, make sure to subscribe to SR Money News. Turn on the notification bell to stay ahead of critical market pivots. We track the macro trends and structural shifts that drive real wealth creation. Let us know your thoughts on this shadow banking pivot in the comments below.